So Andy, one of the big questions that we always get coming into the start of a new year is that where do you think things are going to go? And of course, year over year, nobody really knows. I always say I've got my crystal ball. It's probably broke like everybody else is. But longer term, there are trends that you can really get a good indication where you think things are going to go based on the last 10 years, the way that asset classes perform historically relative to each other. So if you don't mind sharing the chart that I have pulled up here that talks about the last 10 years versus the next 10 years.
Sure, yeah. So up till now, we've been talking pretty recent history, 2020 alone. If you zoom back at the last 10 years, there's been kind of one big story, and that's large U.S. companies. And so what the top chart does there, Seth, is it reconciles what's the difference between that 13% U.S. stock return on average to the foreign stock return of 5.1% on average. That's a big spread. What was the difference? And if there's one misconception that I often hear, it's that U.S. profit growth just completely eclipsed foreign stocks, and our economic activity was so much higher than the foreign stocks that's what drove it. And you can see that directionally that's right. Let's just start on the second red bar. 1.5%. So U.S. profits did grow faster than foreign stocks, but only by 1.5%. So I think most people see 13% stock returns versus 5% stock returns and think, oh, business was just that much better in the States. It was better, but by 1.5% per year on average. And in fact, the dividend yield, so the cash that the foreign stocks pay to the business owners is 1.1% higher than it was in the States. So those two offset a little bit. So the profit growth and then how much cash gets paid off by those profits to the shareholders almost nets out when you look at those two. I start with those two also because those two are less volatile. When you look at 10-year horizons, it's boring. You don't see times where profit growth averages 20% per year or negative 5% per year. It's kind of always in that mid-single digits realm if you give it a decade, both in the States and abroad. So, and dividend yields don't tend to move that fast either. They're nice and boring. The actual business activity that we're investing in is nice and boring. So all that to say, earnings growth was a little bit in the States' favor. Dividend yield was a little bit in overseas' favor. The big difference you can see on the first left bar is valuation change, and that is volatile. So valuation change means you have this level of profit for a business. Do you pay a lot for the stock, or do you pay a little bit of the stock in relation to those profits? And as it goes in the U.S.'s case, as it goes from maybe an average level to an expensive level, you didn't see that in foreign stocks. It was average and stayed about average or a little bit below average. And so that difference, the U.S. companies getting so much more expensive when the foreign companies did not, because that was 5.4% of the outperformance of U.S. markets. Now that doesn't, usually that doesn't go forever, or I guess it never has gone forever is a tighter way to word that. It goes back and forth, it ebbs and flows. So as just excitement goes from one region to the next.
So what you're saying there, basically, Andy, on that part of it is simply that U.S. equities went up 5.4% per year in higher valuations, not because they were necessarily any more profitable, not because anything else was different. U.S. stocks just became that more increasing in value relative to international.
That's right. Or the price that people were willing to pay for the business really ballooned over the last decade in the U.S., where it didn't many other places.
Excellent.
Yeah. And the last ingredient there for at least for U.S. investors, which most of our clients are, is the currency effect. So if you're investing in overseas stocks, the dollar strengthened, and so that detracted 2.1% on average. So you put those all together, 13% for U.S. stocks in total. That was their total return over the decade on average, and then minus 5.4% for valuation change, minus 1.5% for profit growth difference, plus 1.1% for dividend yields, and then minus 2.1 for the dollar effect, and then you've got your 5.1% average returns for foreign stocks. So that was the last 10 years. That's helpful to see because each of those building blocks to the total return, you can also forecast. And what's also nice is two of those are really easy to forecast because earnings growth doesn't change that much and dividend yield doesn't change that much. So switching from the last 10 years to the next 10 years, you can see, and this is Vanguard data that we're quoting from a paper last September, or maybe October, December 2020 was this Vanguard forecast. So switching from the last 10 years to the next 10 years, which is probably what we care about a little bit more, you can see that the picture looks a lot different. And so Vanguard's expecting 4.7% average returns in the US. And that's because US stock multiples are so much more expensive that the price that people are willing to pay for businesses comes back down to a more average level, that's hard on US stock prices in a way that we wouldn't expect it to be for foreign stocks. So if you start with the 4.7% total returns that we expect on average for the states, add 2.2% for the change in how expensive the business is, the valuation change, Vanguard still expects U.S. stocks to grow their profits faster in earnings growth, but not quite as much. So 0.7% is the difference in favor of the states in terms of profit growth. But foreign stocks pay even more dividend yield. The spread that dividends overseas is so much greater now than in the states, or a little bit greater now. So 1.6% more dividends overseas than in the states. And then Vanguard and many others, and myself included, would forecast the dollar to weaken a little bit, which adds, by Vanguard's forecast, 0.3% per year on average, just from the currency effect. And so that all builds up, growing the U.S. equity return of 4.7% over the next decade on average to 8.1% for foreign stocks.
Andy, I would like to just for a brief moment talk about the currency, because when I get into that, I know currency can get in the weeds a little bit and be a little bit complicated. But when I talk about the fact that the weakening dollar is not bad, because a lot of people think, well, don't we want a strong dollar? We're in the U.S. Don't we want that to be strong? And the reality is, economically, a weaker dollar can also be beneficial as well. The way I illustrate, the dollar goes down 5% in value. If you're a multinational company, your goods are now 5% cheaper overseas. And competing goods that might compete with you are coming in at 5% more expensive. So the dollar, just because it weakens, doesn't necessarily mean it's bad, does it?
No, I agree with you. And I would add one other element to what you just described. So you talked about basically how competitive are your prices. You can, in what you just described, if we're selling into France and we're competing against French manufacturers, we have an awesome choice. We can either undercut their price and receive the same revenue in US dollars, or we can raise our price a little bit, receive even more, and still be undercutting the French manufacturer's price. So for an exporter, you're in a good position just in competitive pricing terms. But the other piece of that is your costs are still borne in US dollars. So if you're selling into France, getting those converted into higher US dollars for your sales, but your costs are unchanged because your labor costs, your loan for your business, all that stuff is pretty fixed in US dollars, then that just means your profits grew. So it's kind of a twofold, as long as your costs are still in your home currency, then it's kind of a twofold effect.
And not to, because you always try to avoid the discussion around politics in the markets, because everybody has their own opinion based on administration. Obviously, we had a change in administration. But as we have seen with the new administration coming in, I do view that in all likelihood, they're reinstating us into some different trade pacts already, some different things going on, that it could be a more global friendlier administration that could also bode well for maybe the dollar weakening a little bit as well. So again, you don't want to make decisions based on presidencies and everything else as far as getting in and out of the markets. That's kind of a foolish game. But there are certain things that might do better based on policy than others. Would that be an accurate statement?
Yeah, that's true. That's tough to forecast. So there are other people who I would probably listen to more than me on every little nuance of that. That's true. I mean, I would go the other extreme. So my favorite forecasting tool is just look at 7 years. Currencies tend to go 7-year cycles, one direction, the other. So that's how I get my quick check. And then for the precision, there are a few economists I read that look at, even things like the effect of energy. Like energy is changing, oil is changing. for their currencies that oil is really important to the country that issues that currency. So, even stuff like that, kind of has an effect, and yeah, certainly federal policy is involved with that.
Well, and just to shift gears now a little bit and talk about, because I know we're getting this question a lot, is that bonds are down for the most part, not zero, but I think the 10-year treasuries, 1.03, 1.05% for 10 years. That with rates and bonds being so low, what do we do? If you want to talk, I did pull up another slide. Again, for those listening, these slides will be out on the website, but I did pull up a slide that really references the extreme side effects of what's going on with bond yields, and along with tying it to dividend stock yields. So Andy, if you want to talk a little bit about the slide, that'd be great.
Sure. What do you do? With a 1% Treasury yield. So there are a few things to do. Of course, the probably safe answer is it depends who you are. So if you're a pension fund or an insurance company or a foundation, a community foundation, it probably looks a little bit different, or it might look a little different than a household whose net worth has blossomed and is looking to solve their asset allocation for their family. So it partially depends on that. And so there's a few ways to dissect that. Probably the most important one, in my opinion, to be in the driver's seat is, why are you allocating to bonds? So if you are allocating to bonds because of their diversification effects to stocks, their volatility dampening effects, their yield, their effect on the total portfolio, that sounds more traditionally like what a foundation probably would use them for. And so if you're a foundation, you're making your whole blend solve so that you get a 5% return plus inflation or something close to that. And that's what a lot of this slide is about. We'll get to that in a second. If you're a household, at least one of our favorite ways to allocate why do you have bonds and how many bonds should you have is, we view stocks as the growth engine over time, but stocks are crazy over the short run, as we saw last year. And so you need an important piece that you kind of can sleep easy about and not have to worry about, and that's your bond allocation. You're not counting on them to hit a certain dollar amount. You need an allocation to stress-free money so that your rest can grow without you worry about needing to sell it at the bottom. So the implications of that are probably less consequential for a household than they are for a foundation or a pension fund or you name it. So I'll pause there. You're allowed to disagree with that.
I would agree. I mean,
with
my clients, a lot of the approach that we take on bonds are mitigating risk of owning equities in general, the way that they can stomach the risk tolerance of equities versus bonds, and also cash flow needs. If they have cash flow needs in the portfolio, you obviously don't want to expose that to the equity markets, because in February and March last year, you'd be pretty upset pulling money out of the markets down like they were to fund cash flow, and you don't have the time for that money to rebound. So those are principally the two of the reasons that I see that clients have bond exposure in their portfolio.
Sure. Yeah. So I assume most people listening to this are probably in the household category and not in the foundation category. We work for both profiles, but assuming most of our listeners are households, there are a few things you can do. One of them is do nothing. Keep a pristine treasury portfolio. The yields will, they're not going to get you rich for sure. But it's a high credit-worthy issuer and things like that. We tend to explore outside of the treasury realm, so you can find bonds with shorter maturities and a little bit higher yields if you're willing to bear the risk of a corporation, for example, the risk of the corporation making good on its promises to pay, or other issues, municipalities, things like that. So by going into those other bond sectors, not every bond in the world is paying 1.05% in interest. There are several that are paying, several sectors that are paying more. So you can still get a positive return over time with bonds, even with the treasury where it is right now. So yeah, some people would say you don't need to do anything. We tend to go out a little bit to pursue a little.
And I think that's important, Andy, is that when I had a conversation with a client over the last couple of weeks who has a large amount of money sitting in a corporate checking account, wondering what do we do with it? It's now not earning anything. And my comment again is going through the needs of the cash and when will the cash be used? Do you think you'll ever need it? All those great conversations that have to happen. But the one thing I kept going back to them is that every time you go for higher yield above a treasury or a bank account, it is going to come with a little bit more risk. You just have to acknowledge what that risk is. And if you're a longer term investor, then that's okay. You can absorb a little bit of interest rate risk. It's not like the equity risk that you can see, obviously, but there is risk there. So do you want to talk a little bit about, because we have had that question about, well, I'm going to look at stocks because as you mentioned or on the screen here, the dividend yields of stocks are paying more than what a treasury is. Should I not just invest in a high dividend yielding stock instead of bonds and call it a day?
Good point. And the other element of that is if inflation shows up, typically that means the goods that these businesses are selling are getting more pricey. And so that means your stock market investment even adjusts for inflation for you, whereas a 10-year treasury would not. It would be that, that's your number, and if it's above inflation, great. If it's below inflation, too bad. So that makes it even more in favor of stocks when you compare the two. And I think if you give it a decade, yeah, the odds are overwhelmingly in favor of stocks. Stocks usually win when you give them a decade over treasuries, but right now, I would say the odds are even stronger for, will you get compensated for bearing your stock risk? That gap is so wide, even on a dividend versus yield basis, even ignoring the inflation, the desirable inflation element of stocks that treasury bonds don't have. It makes that decade even more confident that you're getting paid for your stock risk. Even with, as we talked before, 4.7 is not an ambitious target for U.S. stocks. So that's kind of, when we talk about this stuff, comparing stocks to bonds, that's about the most optimistic way you can look at stocks. You can almost get excited about them again, even with those lower return expectations than average, because everything else, at least very high quality bonds pays so little these days.
Yeah.
Yeah. Now we would, to your point though, it's not all about that horse race. You don't have 10 years with all of your money. So you're not just picking what's going to win over the long run. You're planting enough there that you have satisfactory growth, but enough in the low risk stuff. Even if it's not yielding much, that's okay. Just, mentally take that step and let yourself sleep easy at night.
And that's exactly where on the financial planning side, as we go through that process of cash flow needs over not just short term, but intermediate and long term, that's really what starts to guide us in that amount that we do keep in bonds, with the idea that, 10 years from now, the odds are in your favor. You're going to be happier with stocks and bond returns, which historically, other than a couple periods in history, been the case. However, getting from year 1 to year 10 could come with a lot of ups and downs. And if you're having withdrawals and other situations, it would not maybe make sense to subject all the money into equities, and that's where you map out that right portfolio, the right allocation, and then you tweak it as the years go on. The rebalancing that we talked about earlier, it all has its purpose in the way that you're investing your funds.
Totally. So yeah, having your head wrapped around the whole financial picture, opposed to mentally, my stock strategy is over here, my bond strategy is over here, my cash needs are over here, and these little pockets in your mind that you revisit after Christmas or on your anniversary or whatever. There's real value to, it makes it so much more robust to have all those dimensions working together. Yeah,
Well, Andy, as we're getting close to time here, are there any last parting shots or anything else you would like for the listeners to hear as we look at this year and more importantly out into the next several years?
Sure. Yeah. So, this is an important year to celebrate. The market rewards optimists. The market rewards the persistence. So for those who stayed in your seats in 2020, let yourself get the pat on the back for, your portfolio is better for it. So definitely take the time to do a nice deep diaphragm breath and appreciate the persistence being rewarded. So in terms of the market rewarding optimists, that's the last thing I like about this slide that you have pulled up now, Seth. And if somebody's just listening, this shows that difference in yield, stocks yielding more than bonds, than treasury bonds. We haven't seen that since like the 50s. And it's not just ExxonMobil stock yielding a bunch. 70% of the stocks in the S&P 500 have higher yields than the Treasury. So this is a broad stock market condition compared to bonds. And so, what's this have to do with optimism, Andy? It's reasonable to see the economy not booming. It's reasonable to see a lot of national unrest and see stock prices where they are. Stocks are expensive in the States, and say, I don't want to play. The game's over. Why keep doing this? And so, if you compare them to foreign stocks, it certainly would make you attracted to foreign stocks. But you can also compare them to bonds, and there's an important ingredient there. So we talked a lot about households. If you switch that to the foundation or pension fund idea, you can see that they have numbers. They have targeted returns that they have to hit, or else something goes wrong for the foundation or the pension fund. And if treasuries are yielding, bounced off 0.5% weeks ago, 1%, you can do the math. You need 5% on your portfolio. That means I don't care that stocks are a little bit pricey. If I'm an endowment, I have to up my stock allocation. I'm a buyer at these levels, and I'm a buyer for the foreseeable future. And so what we have here is the biggest portfolio in the world, or at least the biggest one I'm aware of, the Norway Oil Fund, has $1 trillion portfolio. Look it up on Wikipedia. It's a fascinating portfolio. But they've grown from 40% in stocks back in the late 90s. You didn't need a lot of stocks to get returns. If you need 5%, your bond yields could satisfy that for you. Now, as time has progressed and that spread between stocks and bonds has changed, they've gone up to 70% in stocks. And so the point is just this: with these low bond yields, with so much liquidity out there, nobody knows the future, but I think it's reasonable to expect big portfolios like this that have to get a certain return target, 5% plus inflation, something like that, they have to be buying stocks. And so the point is, are stocks expensive today, in the States especially? Yeah, I think so. Do you have a buyer there that if there are dips, is probably going to be coming in and buying the dips and not keeping it there too long? I also think that's kind of reasonable to expect for where markets are right now. So one last little dose of optimism that, the stock market in the States especially is a little bit high, but it could stay high for a long time.
And I would comment on that a little bit, Andy, too, when you talk about the stock valuations in the U.S. are high. When you look at like the S&P 500 index, definitely an argument to be made there. But with the idea that, 6 stocks in the S&P 500 index make up, 25 to 30% of the return, right around there. And those are your 6 big tech stocks, which one could argue are overvalued, an Amazon at 100 price to earnings multiple and so on.
Right.
However, there are also parts of the market that are reasonably valued as well. The value stocks that maybe have not gone up as much the last 5 years. I just, and that's what we search for, are the value parts of the market. And I always laugh about this because I was talking to a client the other day about international, as we've added more into that space. And, well, why do you want to invest in them? Look at how bad they've been. And I kind of chuckle and said, well, isn't the goal of an investor to buy low and sell high? It sounds so easy to do conceptually, but also so hard to do, because when you're selling your winners to buy things that have been losers, it's always not as easy. And that's what fascinates me about behavioral science when it comes to investing, is what sounds easy is so hard to do.
Totally. Yeah, buy low, sell high is everybody's first lesson. But I thought this was the good stuff. This is the stuff that made me look smart. This is what made me thousands of dollars. Let's break up.
It's hard.
That's a tough argument. Yeah.
Well, thank you so much again, Andy, today for being part of this podcast. Hopefully everybody got something out of this. For those that are clients, your advisors will be sharing a lot of this with you, obviously with your meetings that are coming up. Again, Andy, I appreciate your time today, and thank you.
Thanks, Seth. Yeah, I really enjoyed this.
Thanks for joining us for today's podcast. We hope you enjoyed listening as much as we enjoyed having you. For more market insights, financial planning tips, or just to check out our smiling faces, visit us online at SYM.com. Until next time, stay well and plan on.